Welcome to today's breakdown. Today, we're diving into what honestly feels like a survival guide. We're unpacking Lennar Corporation's second quarter 2026 earnings report. Now, whether you follow the real estate market religiously or you're just trying to make sense of the broader economy, this report is an absolute masterclass in how a massive company navigates a historically challenging landscape. You see, Lennar isn't just building houses right now. They are engineering a financial and operational playbook to survive and even thrive when the economic weather gets incredibly rough.
To really grasp what they're up against right now, just listen to this quote from Lennar's executive chairman, Stuart Miller. He stated, point blank, "Our second quarter of fiscal year 2026 was defined by the same stubborn headwinds that have challenged the housing market." That right there, that immediately establishes the central macroeconomic conflict of our story today. It is simply not a market where homes sell themselves anymore.
Okay, let's lay out the roadmap for our analysis today. First, we'll tackle those stubborn housing headwinds. Second, we'll run through the Q2 financial highlights. Third, we'll open up their operational playbook. And finally, we'll wrap things up by looking at their future outlook and strategy.
Let's jump right into Section 1, the stubborn housing headwinds.
Before we can fully appreciate Lennar's game plan, we really need to understand the macroeconomic reality facing builders and prospective buyers alike in 2026. If you've been window shopping on Zillow lately, you know exactly what this means. It all boils down to the affordability challenge. This is the defining constant that Lennar absolutely has to maneuver around. For the past few years, the market has been locked in this vicious triangle: higher home prices, elevated interest rates, and household incomes that just haven't scaled fast enough to comfortably cover the gap. Every single decision Lennar makes right now is a direct response to this specific mismatch.
So, how did they fare? Let's get into Section 2, Q2 financial highlights. With that massive affordability cloud hanging over the entire market, how did Lennar actually perform? Well, $7.9 billion. That is the absolute sheer volume of total revenue they brought in during their second quarter ending May 31st, 2026. So despite all those intense headwinds we just talked about, they are still generating an enormous amount of top-line revenue. And from that $7.9 billion top line, they pulled in net earnings attributable to Lennar of $305 million for the quarter. That breaks down to $1.24 per diluted share. The bottom line here is crystal clear. Even in a tough market, they are highly, highly profitable.
Now you might be wondering, where exactly is all that cash coming from? While it's true they're diversified, bringing in over $236 million from financial services and about $63 million from multifamily developments, single-family home building is the undeniable core engine of the whole shebang. It accounts for a staggering $7.61 billion of their Q2 revenue.
Now this right here is where things get really fascinating. Just think about the dynamic between volume and price for a second. In Q2 of 2025, they delivered a little over 20,100 homes at an average price of $389,000. But flash forward to Q2 of 2026, they actually delivered more homes, 20,519 to be exact, but the average sales price dropped by $18,000, down to $371,000. To keep volume moving in a weak market, they had to purposefully bring their prices down.
Which leads us perfectly into Section 3, the operational playbook. If you are dropping the average price of the homes you sell by 18 grand, how on earth do you protect your profit margins? Well, the answer is right here in this quote from Stuart Miller. Our strategy consistently has been to execute around the affordability challenge rather than wait it out. Lennar didn't just sit back on their heels and hope interest rates would magically drop. No way. They chose aggressive, internal, operational adaptation. They leaned in.
So how did they execute that strategy? Through massive, across-the-board efficiency wins. Because they prioritized volume, they created durable scale advantages. Their construction costs actually dropped another 2% sequentially. They reduced their inventory to just 2.1 homes per community. And because they tightened up these operations so incredibly well, they were able to offer buyers a massive 12.9% incentive to help them afford the home, all while still protecting a very healthy 15.6% gross margin for themselves. That's a huge win.
And honestly, this metric perfectly illustrates one of their biggest operational victories: cycle time. That's literally just how long it takes to build a home. In Q2 of last year, it took them 132 days. By Q1 of 2026, they got it down to 122. And now, they've hit a record low of 121 days. Shaving 11 days off construction over a single year is absolutely crucial. It means less capital is tied up in a half-built house, which dramatically improves a builder's cash flow.
All of this feeds directly into their overall financial posture, highlighted by what they call an asset-light strategy. Think of it like traveling light during a massive storm. Right now, less than 5% of Lennar's land is actually held on their balance sheet. You see, in real estate, owning massive tracts of undeveloped land carries huge financial risk if the market suddenly turns. By keeping their land holdings light, they drastically reduce that risk and free up incredible amounts of capital. In fact, they ended the quarter sitting on $1.8 billion in cash.
All right, let's zoom out a bit for Section 4, Future Outlook and Strategy.
With a fortress of a balance sheet and these super-tuned operations, what comes next? Well, here's their forward guidance for Q3. They expect the momentum to just keep rolling. They project delivering between 2,500 and 21,500 homes. What's really vital to note here is they expect slight improvements across the board. The average sales price is projected to tick back up slightly to between $375,000 and $380,000. And as their cost discipline gains even more traction, they actually expect their gross margin to improve to roughly 16%.
A big reason for that expected margin improvement actually relates back to buyer incentives. Right now, Lennar is offering a hefty 12.9% in incentives just to help buyers bridge that affordability gap we keep talking about. Historically, normal incentive levels sit way down between 4% and 6%. But Lennar's management noted that for the first time in 3 years, this gap is finally starting to narrow. As wages slowly drift higher and employment remains strong, the extreme mismatch in affordability is beginning to ease up. However, no company is entirely immune to the broader world. Because of current pressures on interest rates and ongoing geopolitical uncertainty, they are slightly moderating their full-year 2026 delivery targets to approximately 82,000 to 83,000 homes. It's a calculated, realistic adjustment to a pretty unpredictable global environment.
Which leaves us with this incredibly important final thought to chew on. Lennar makes it clear that the fundamental shortage of housing in America has absolutely not been solved. The demand is out there, it's very real, it's just deferred, and it is building up behind the scenes. So the ultimate question is, as conditions begin to normalize, will this massive wave of deferred demand finally outpace these stubborn economic headwinds? Lennar certainly believes they've built the perfect machine to capture it when it does. Thank you so much for joining me for this breakdown. I hope it helped you get a clear look at the complex gears turning inside today's housing market. Keep learning, and I'll catch you next time.